Hello and welcome to another weekly review. My name is Grant Collins. I'm an independent economist with AIM Research, and I'm happy to share an update with you today of the data that came out this week, primarily the inflation data. We're going to talk a little bit about interest rates, banks, liabilities, and deposits, as well as the Fed. The Fed is going to meet here in just a couple weeks on July 25th and 26th to make another interest rate decision. And now we have both of their pieces of data in hand. We've got the employment data from last week, and then we have the inflation data of this week. Just briefly, I'll talk about the employment data. It did come in my opinion, better than expected. I'm going to stick by some of my previous comments that it is weakening, and that weakening is something that we need to think about and that we can't ignore, even though there are still being, although there's still being jobs added. A couple of things that I found that strong in this report: the quits rate ticked up. The hiring rate stayed relatively the same. The job openings came down, but are still extremely elevated, just under 10 million, I believe, right around 9.8 million, I believe. Other things that I saw here was average weekly hours ticked up very slightly, from 34.3 to 34.4. And then finally, the participation rate remained the same. So again, just digging into some of the employment data and some of the nuances there was a big difference between the ADP and the non-farm payrolls. The ADP went through a really big revision when their chief economist, Neela Richardson, came on board. And so I do think that has an impact on this. The ADP, on the other hand, showed a lot more jobs gained at 497,000 versus the non-farm payrolls at 209,000. But to me, I think the general trend and the direction is still lower, and that's evident from the Kansas City Fed labor market indicator. Now, today, though, that's one mandate that the Fed is concerned about, is the employment mandate. The mandate that we're going to talk about today is the inflation mandate. So the inflation mandate, in my opinion, I think has seen a lot of progress. I'm going to show you some charts to show you even more progress that's being made. Now the Fed has to finally make a decision, right? They've got the employment data in hand, they've got the inflation data in hand, and now we're turning into what should they do next? And that's really the title of this. Is inflation declining? What will the Fed do next? So let me start by sharing my screen and we can dig into some of this data here. So we're going to focus on just the CPI report. The CPI report month over month came in at 0.2%. That's headline, so including food and energy. The expected was 0.3, so it came in below expectations. And the prior month was 0.4, so it also came down from the prior month. Now, on a year-over-year perspective, that's right at 3.09%. So again, you can see how far that's come over the last, call it, year or so, from the summertime of last year to the summertime of this year. The prior month was 4%. So we are seeing, again, a reduction in a year-over-year monthly perspective as well. Contrast that with core. So once you remove that food and energy, you're sitting at 4.86. Core had accelerated basically the exact same amount, accelerating 0.2%, where again, they were expecting 0.3. Now, the biggest lion's share of the increase in inflation was shelter, and you can see it here in the blue line here, shelter up 7.8%, and you can kind of barely see it in the chart here. The biggest detractors, food and energy really coming down. It's been interesting, just a quick note, over the last, call it, month and a half, we've seen oil prices rising again, so maybe we'll see energy start to turn the corner here. Just briefly, but definitely shelter being the driver of this inflationary problem, and services still being the driver of this primary inflation problem. Because again, when you look at durable goods and non-durable goods, they're negative. They're actually outright deflationary right now, where services is still somewhat inflationary. If you take shelter out, so leave food and energy in, which is volatile, but take the shelter away, you can see that inflation is at 0.826. To me, that is a great win for the Fed. And for those of us that have mentioned transitory, I guess maybe to the Fed's credit, it was transitory if you consider 27 months transitory. Now, that does begin to make us think, right? Well, what should the Fed do? You know, inflation is falling. It's falling pretty quickly. It's falling pretty consistently. They're looking primarily at core here. And so they're seeing close to 5 when they want to be at 2. So do they stay tunnel visioned, right? Do they stay only razor focused on core and just continue raising rates regardless of what's happening in the economy? Or do they actually continue to pause here and allow more time for the inflation rate to kind of naturally come lower because economic activity is slower? I think you've listened to enough of my videos to hear that yes, we're growing near trend, but I think we're growing below trend, and that's going to be continuing to be the case. That's going to make us vulnerable to a recession. I've also mentioned that the economy has signs of restricted activity. We're going to look at banking here in just a second. That's one area of restrictive activity. I'm going to show you a couple other things. If we can come down a little bit further. One of the other things that I'm seeing on a restrictive level is in the interest rates. I'm sorry, we're going to look at interest rates in a second. But I did want to point this out to also make the Fed decision a little bit difficult as well. Wages are still tracking relatively above the current inflation rate, both core PCE and core CPI. So again, all of this is painting a picture that, hey, progress is being made. And I believe the Fed should be taking a victory lap here and saying, okay, we should be pausing and still allow the tightening that we've done to work its way through the system. Now, let me show you why I think they're still very restrictive. One of the things that when we talk about Fed policy, now that all of this data has come in, market reaction is a starting point because the market moves very quickly to try to price what they think is going to happen. So to answer this question of what should the Fed do, let's first look at what the market's pricing. Well, if you look at the 1-month Treasury rate at 5.36, that's come up dramatically. So the 1 month is actually pricing in another quarter basis point or another 1/4% increase. That's important to know, especially when you come down here and look at the Fed funds graph and see that the blue line, the 1-month Treasury rate, tends to fit inside of the lower and upper barrier of the Fed funds range, and it tends to track the effective federal funds rate very closely. What is the effective federal funds rate right now? It's 5.08. So the 1 month is at 5.36. Let's go back up for a second, 5.36. Effective federal funds is 508. So they're pricing in this next rate hike. Again, I think the Fed should just pause here and do nothing. One of the reasons why is they're pretty restrictive already. One way that we can see this is many economists were saying that they needed to get the Fed funds rate above the inflation rate, so that way you had real rates positive and real rates would start to drag on economic growth. Well, we're here, right? The Fed funds rate is at 508. The core CPI rate's now at 4.86. And as we just looked, going back one more, the core PCE, which is probably their favorite measure, the one that they look at quite a bit, that's at 4.55. So, okay, so the Fed funds rate is greater than inflation. We have real positive interest rates right now, and that's creating a system that is restrictive from a credit perspective. So we're going to actually flip over here to bank assets and liabilities, and you're going to see that bank loans have been declining. We know that deposits have been declining because as interest rates have gone up, money markets have been really attractive. And so we've seen an outflow from banks into money market funds. But I really want to come down, and these charts, if you're subscribed to our research, are going to be shared with you. So feel free to look at any of these. We want to look at loans and leases. So you can see that this is in billions of dollars. So large banks and small banks alike make a ton of loans in the economy, large banks making the large majority of them at 6.7 trillion versus small banks at 4.3 trillion. But total loans and leases are about $12 trillion. So if we come down and look at that, you can see the trend setting at 12.182 versus the actual loans being made at 12.091. You can see that that's about $91 billion below trend, and that's a pretty sharp reduction. Let me grab a highlighter here. This is a pretty sharp reduction. Also, I would highlight here, this looks to be a critical level if we go back to 2008, that we had breached this, I believe this is 100 billion below. So we're not quite at 100 billion, but very, very close in this reduction of loans. Now we want to break this apart. Is it commercial loans? Is it residential loans? Is it like, where is the tightening coming from? Again, you can look at the difference between small banks and large banks right now. Particularly, it's larger banks that are seeing this detractor in loan growth. Let's start with C&I loans. So C&I loans, we can see a small reduction in the all bank C&I loan cycle. I wouldn't say that that's the primary driver. If we come down to real estate loans, I will say that this one is where we're seeing the large majority of it. So you can see a really big drop in real estate loans. In fact, it's about $55 billion below trend here, and looks really eerily similar to the great financial crisis as far as a drop of loans. Now, remember, the level that we're starting at is much, much higher because of the trend of growth post-COVID, right? There was a lot of activity and a lot of dollars and a lot of money supply thrown at this. And so that is something that we have to take into consideration as the banks begin to make less and less loans. Now, going back to this top chart here, small banks primarily had the lion's share of real estate loans. So if we come down here and look at the small bank real estate loans, you can see that they're declining pretty rapidly. And it looked like they were a precursor to the recession. So they declined a lot sooner than the recession really set in. And so this decline could be a quote unquote precursor. Let's dig into this a little bit further. Again, you can see large banks having a pretty big drawdown in real estate loans as well. So here's commercial real estate. I think everybody talks about this being a problem. We are seeing it directionally lower for all the banks, lower for small banks. Here is residential real estate, and I think you're going to see this as the primary driver, in my opinion, as well. Roughly $37 billion below trend there. Small banks having a pretty good downdraft there. Large banks, look at large banks, a real big drop in residential real estate loans. So, you know, to me, I think that's where the problem is persisting. So you have inflation coming down, you have real rates positive, right? So the Fed is restrictive enough, in my opinion. I don't think they need to do any more. They need to let their policy kind of set in here. And to me, the banking system is showing that restrictive policy stance. Yes, we've avoided a banking crisis by bailing out and backstopping all deposits during the Silicon Valley Bank debacle. But here again, in my opinion, when Jerome Powell talks about speed, level, and duration, now you're moving into the duration conversation. I think the level is right here at 5%. And so the duration is now going to be, okay, how long can we leave rates restrictive? You know, the Fed's already forecasting their own recession, right? They're saying they want the unemployment rate up to 4.6% by year end. And they're saying that that they believe that interest rates are going to come down to 4.6% next year. So they're forecasting a recession and forecasting cuts over the next, call it, 12 to 15 months. Well, to me, it would make a lot more sense to remove those two interest rate hikes that they have on the table, have that duration of having rates higher for a little bit longer, but you're going to get this adjustment period where people may find kind of a right size here where rates are higher than they were. They're higher than zero, but they're not they're not so high that you're going to just destroy all economic activity. It's clear that we're still seeing some existing home sales move. We're still seeing some new home sales move, right? So it's not going to deter all economic activity. But what you can do to still have some strong language in the background, in my opinion, is you can have balance sheet runoff continue in the background because you do have a lot of runway there, at least by my calculation. So I've mentioned this before in prior videos, but I believe currency in circulation can potentially be the floor in this ample reserve regime. So if the Fed is setting at $3.1 trillion in reserves and the floor, let's say, is $2.3 trillion, well, they have quite a bit of runway at this $95 billion a month to keep drawing this down. And to me, it's not being drawn down by the rebuilding of the TGA. Looks like as the TGA rebuilds, it's coming primarily from the reverse repo market. So, I do think that there's the ability to draw down the reserves at the same time that you pause your interest rate hikes and you just continue to trend sideways from here. And so then you're still restrictive on the economy because you're still pulling liquidity out. However, you're not introducing interest rate risk. You're not introducing interest rate uncertainty. And so to me, I feel like that could be the potential path forward from here. The fun part is we get to watch and see if that's what actually happens. Let's talk a little bit about what if that doesn't happen. If that doesn't happen, I think as investors, we have to think of a couple things. One, we have to think of a repricing of the 2-year. The 2-year at 4.7 is pricing in the cuts that the Fed has been pricing in, and you probably have to reprice the 10-year, right? Both of those, I would imagine, inflect higher from here. And for fixed income investors, that potentially could be painful. Now, what about the equity market? Well, the equity market's been looking through interest rate hikes and they've been moving on to earnings. But if the Fed continues to raise interest rates, that's a key determinant into calculating earnings expectations and earnings estimates. So if interest rates are going up, those estimates will be coming down. That should keep a lid on stock prices. It's a big reason why I came into the year saying, look, I think both economic data and the stock market's going to be trending sideways for 2023. I've kind of gotten caught in the middle because we've got the economic data right. It has moved sideways, but we have seen a big spike in the stock market after these dominoes of worries have started to get out of there. The worry that inflation is a problem, a worry that we've got bank failures, a worry that the debt ceiling wasn't going to get raised. And it seemed like every single one of those issues are getting resolved, albeit slowly. And as they've been getting resolved, the market has been turning and pivoting to earnings. And even though earnings are negative, they're better than what has been previously expected. In fact, FactSet, as of last week, had earnings expectations of minus 7.2% for the second quarter. Well, for the first quarter, I believe, if I remember this right, they came in at like minus 2.1. So as long as they continue to come in better than expected, you could probably still see a market that looks somewhat resilient, may not run all the way back to the 2021 highs, but continue to kind of have this slow recovery, assuming there's no more shocks. I'm going to say assuming there's no more shocks, because I do think the Fed could make a policy mistake here by staying tunnel visioned to core inflation, by staying tunnel vision to the fact that, okay, we've made progress, but we've not made enough progress. Look at shelter, look at services. We need to keep raising rates. I think that potentially could be a policy mistake, and it could definitely raise the odds of a hard landing. Now, what's coming out this week, right? So we covered the inflation data. We briefly hit at the very beginning of this on the employment data. What's coming out this coming week has a lot to do with the manufacturing side of the economy. You're going to get the New York and Philadelphia Fed manufacturing survey data. You're going to get housing starts and building permits. You're going to get industrial production. You're going to get retail sales. So you got a lot of data coming out this coming week that could help us determine really if the economy has slowed any further as we start the second quarter here. It's pretty clear. As we start the third quarter here, it's pretty clear that the second quarter is going to come in with some more positive growth relative to what everybody was expecting. I still expect it to be below trend growth, on a year-over-year perspective. So we'll see how that comes out at the end of July here. We're going to get the second quarter first estimate of GDP, and I'll bring you my estimate of that before we get there, so that way you're prepared for that as well. With that, I think this is a great place for us to stop. We're going to help you stay up to date with all this data coming out next week. That's going to help us continue to align on whether the economy is indeed recovering, if it's just going to continue to kind of have this slow kind of malaise, so to speak, or as some would call it, some stagflation, since you still have a little bit of inflation in the system. Again, I'm in the camp that the economy is going to be growing slower. That slower growth will likely bring in slower profits. Slower profits is what's going to feed into the stock market, right? Whether or not they beat expectations on their earnings estimates. And that should be enough to help continue to bring the inflation rate lower. So I do see a path to a soft landing. However, it's in the hands of the Fed, and then we have to assume that the Fed is going to make the right decision. So in my opinion, there's only two decisions that they can make, the right one or the wrong one. So let's see, it's a 50-50 chance. So we'll leave it at that. We'll see how this develops. We'll continue to bring you updates. If you like these, feel free to leave a comment below or shoot me an email. I'm happy to answer those questions for you. They definitely help give me a general idea of what you're looking at, or what questions that you're trying to answer that can be helpful for you in your practice. And at the same time, give us a like and subscribe to the YouTube channel. That tells YouTube that you like these videos and they recommend them to others as well. So with that, I hope you had a great week. I hope you have a great weekend, and we'll be back again next week with more updates.